Inflation is spiking across the world, and we're seeing prices rise at rates that we haven't seen for decades. So many people are worried about protecting their portfolio against these price rises. So in this video, we're going to drill into one particular hedge, which is very effective, called inflation-linked bonds. So how do they work? How does break-even inflation work? Because that tells you whether to buy them or not, but also some of the funds you can buy that give you exposure to this asset class. So let's look at inflation-linked bonds in a bit more detail. This video is sponsored by NordVPN, an app that lets you securely connect to the internet across all of your devices from anywhere in the world. Let's start off with the reasons for buying inflation-linked bonds in the first place. Now, many of the reasons you'd hold inflation-linked bonds are the same as the reasons why you'd hold normal government bonds which aren't linked to inflation. So that would be capital preservation. They don't tend to lose a lot of their capital like equities sometimes do. They also provide some diversification if you are holding equity because they don't move in the same direction as equity, particularly during those sharp downward movements. Inflation-linked bonds, in contrast, tend to rally during those big equity falls. And finally, they provide a very safe, small income. That income is particularly small at the moment, but as interest rates rise, you'd expect to see those coupons increase over time. Now, this is what a normal government bond looks like. These are the cash flows. So when the bond is first issued, you'd pay $100 for it. Then each year, say, you'd receive $1 of income. So this is in year 1. Year 2, year 3, and notice how that income stays fixed for the life of the bond. That's why it's called fixed income. And then at maturity, you receive your principal back. So really the upside on these things is severely limited. All you really get in addition to your principal back is the coupons in the interim. And that's assuming you hold it to maturity. Sometimes you could sell it for a profit before maturity, but even then you won't get a lot of upside. So in what follows, we'll be contrasting two types of government bonds. The normal ones that we think about all the time, these are called nominal US Treasuries. You can think of nominal as meaning normal, but the key thing is that the principal of the bond, that 100 that you paid up front, will stay fixed for the life of the bond, and you'll get 100 back at the end of the life of the bond on the maturity date. But also those coupon payments will be fixed for the life of the bond. And we'll be contrasting nominal government bonds with Treasury inflation protected securities, or TIPS. Now these are quite different in that the principal and the coupons are linked to the rate of inflation, CPI inflation, over the life of the bond. And as we'll discuss later on, the key number you have to look at is the rate of break-even inflation. If you think inflation will exceed the break-even rate over the life of the bond, then you'd buy inflation-linked bonds, which in the US are called TIPS, and in the UK they're called inflation-linked gilts. If you don't think that inflation will on average exceed the break-even rate over the life of the bond, then you'd simply go for normal government bonds, nominal bonds. So this is why it's really important to understand what break-even inflation is, and that's so you can decide whether it's worthwhile buying inflation-linked bonds in the first place. Before we move on to talk about break-even inflation, let me just quickly mention NordVPN, which is an app I use to access my brokerage accounts when I want extra security. And the reason why it offers extra security is that it encrypts all of the information when I'm using the internet. So even if there was someone intercepting information, it's heavily encrypted. Also, if I'm traveling abroad and I want to access my UK accounts as if I was still in the UK, I can do that very easily, simply by specifying one of the UK servers when I connect to NordVPN. Now I use Linux, as many of you will know, and NordVPN has an app which works on my platform, which is great. It also works on my phone, my iPad, and if I had a Macintosh computer, it would work on that too. If I want to connect to NordVPN, I just type NordVPN connect. So let's say I want to connect as if I was logged in France. I just type France. And that's it. Now it looks as if I'm connected from a French network. This is what it looks like if you connect with your phone, and you can see at the top it says VPN not connected. I can choose any of these countries, and here I've chosen the UK, and it looks as if I'm logged in from that country. Now for PensionCraft viewers, we've got a special discount code where you can get 1 month free access and 72% savings for a 2-year plan. Now you can use up to 6 devices and you can get servers in 60 countries if you make use of that offer. And you also get a 30-day money-back guarantee. If you want to try out NordVPN, just go to nordvpn.com/PensionCraft and use the promo code PensionCraft, which is the name of our channel. What we're going to do is compare two bonds which were issued at the same time, but in order to overcome some of the technicalities, I'm going to give them human names. So we'll compare Nominal Norm and Tips Tony. So let's start off with Nominal Norm. Now you can see why I gave him a human name. Bonds are usually identified by quite technical names, so usually you give the coupon and maturity date. So Nominal Norm would actually be known as the 5 1/4 of 28. Or if you want to be really specific, you could identify Norm by his QSIP code. I think Norm's a definite improvement. So Norm was born in 1998 in November, and if you held Norm till he matures or dies in 2028 because he's a 30-year bond, then you get your $100 back on that maturity date. Now in the interim, you'd receive lots of coupons. In fact, you get 2 of those every year for 30 years, so there are 60 different coupons you'd receive. Now because these coupons are paid twice a year, you get half of that 5.25% every year, and it would be 5.25% of the principal which you'd bought. So that would be a payment of just over $2.60 every 6 months. Now notice that all of these coupons are fixed and stay constant for the life of the bond. And that means that if inflation does increase a lot, then the buying power of your coupons and your principal will gradually diminish over time. And that's why inflation is described as kryptonite for bonds. If the payments are fixed and the principal is fixed, then there's a gradual erosion of value over time. And here's our other 30-year character. This is Tips Tony. He was also born in 1998. In fact, he was born slightly earlier in the year, in April. His interest rate is 3.625%, so less than it is for Nominal Norm. But you can see the maturity date is in 2028. There's an additional piece of information here, which is the CPI level when the bond was first created, and that was 161.74. So whenever we're working out the coupons on the principal, we'll always be looking at the level of CPI relative to that 161 value. Tips Tony's real name, the one that bond traders would actually use, would be the Tips of April 2028. That's usually enough to identify the bond uniquely. But if you wanted to be really specific again, you could use the QSIP code here. Now in this top panel, you can see CPI inflation from the time that Tony was actually born in 1998 all the way up to 2022, which is when I'm making this video. And the level of CPI has increased by 75% over that time. So the key number we'll be using to work out the principal and the coupon payments for Tony is something called the inflation index ratio. To work that out, we just take the level of CPI and divide it by the initial rate when Tony was born. And if we look at it right now, you can see it's reached 1.75 because inflation's gone up by 75%. But so is the principal for Tony, and so have Tony's coupons. The website Treasury Direct is brilliant because it allows you to buy US government bonds, including TIPS, and it explains how they work really well. So for example, for TIPS, it tells you how to work out exactly what the principal should be today, but also the coupons. And it has a nice lookup table, which is called the TIPS Inflation Index Ratios. And if we click through to Tony's page on that reference, this is what it looks like. So notice it's got that key index ratio, which is currently 1.75. So if we use their calculation method to work out the principal of Tony, we initially paid 100 when Tony was born in 1998. We multiply that by the index ratio, and Tony's principal is now over $175. And that's the beauty of inflation-linked bonds. The principal's gone up a lot over that period of time. And if we want to work out the coupon, it's just a percentage of that inflation-adjusted principal. Remember, the initial coupon rate was 3.625%. We have 2 coupons per year, so we multiply by a half. So the semi-annual interest payment is currently just over $3. And if we calculate the size of those coupons since 1998, when Tony was born, they started off at just over $1.80, and they've been gradually increasing over that time, such that most recently they've been over $3. So I've shown in red the coupon payments which will be paid between now and the time Tony matures in 2028, and I put question marks above them and shown them in red because we don't know what they're going to be. But what we do know is that they'll be linked to the rate of inflation, and inflation's increasing pretty fast right now at over 7%. And so that means that the coupon payments will also increase at over 7%. So while they are unknown, at least you have the comfort of knowing that they'll be linked to inflation. Now let's talk about the break-even rate and how it lets you choose whether it's a good time to buy inflation-linked bonds or not. Now, if we look back to the birth date of Tips Tony and Nominal Norm, notice how the initial coupon is very different, even though both of them were issued by the same government, the US government, in the same currency, which is US dollars. Tips Tony's coupon is only 3.625%, whereas Nominal Norm is much higher, it's 5.25%. And that's because tips are always issued such that their coupon is less than an equivalent nominal bond. In order for Tips Tony to catch up with Nominal Norm, he has to exceed a certain rate of inflation over his lifetime, and that's called the break-even rate of inflation. Here are Tony's cash flows again, and the dashed red line that you can see here are the level of coupon that you'd get if you were buying the nominal bond. Notice that it takes many years for the coupon to catch up with the nominal bonds coupon. It takes well over a decade. In fact, it takes almost till 2015 for Tony's coupons to be as big as Norman's. So if we look at the cumulative income that we'd have received, in other words, we just add up the coupons over time, if we'd have bought both bonds in 1998, notice how Nominal Norm just keeps on increasing at a constant rate because its coupons are always the same. Whereas Tips Tony starts off at a smaller gradient because his coupons are smaller, but as inflation starts to pick up over time, you can see his coupons are accelerating and they almost catch up with Nominal Norm just before 2022. So in terms of the income you'd have received since 1998, you'd have still been better off with Nominal Norm. But the real winner for inflation-linked bonds for tips is the effect on their principal payment. Remember that with a normal government bond, you give 100 and you receive 100 at maturity. With a tips bond, you get a really large increase in the principal over long periods of time. So the blue line shows you Tips Tony's principal over time, and you can see Nominal Norm's doesn't increase at all. And that's why if you compare the prices of the two bonds, Tips Tony actually does pretty well. He keeps up quite well with Nominal Norm because of the dominating effect of that principal payment increasing as inflation increases. But notice also that at the beginning of 2022, both of these bonds have been falling very sharply in price. And that's because interest rates have been increasing, both real interest rates, which affect Tony, but also nominal interest rates, which affect Norm. So these certainly aren't risk-free bonds. Far from it. They can lose value just as you could with a nominal bond. Most of us won't buy individual inflation-linked bonds. What we'll buy is bond funds which contain inflation-linked bonds. So again, we're faced with a choice. Should we go for the nominal Treasury fund, which in this case is the iShares 7 to 10 year ETF with the ticker CBU0, or should we go for the inflation-linked bond fund? This is the iShares USD Tips Fund, IDTP. You can see the inflation-linked bond fund in blue and the nominal Treasury fund in red. Now these were trading pretty much in line with each other, but you can see that recently as inflation spiked, IDTP, the inflation-linked fund, has moved ahead of the nominal bond fund. Now at the beginning we said that break-even inflation was a very important thing to know about, because that tells you when to buy inflation-linked bonds and when not to. So the actual definition of break-even inflation, and it usually comes with a maturity built into it, so here we're talking about 10-year break-evens, is that it's the rate of inflation which is expected by market participants over a certain period of time. Now, if you want access to this, you can get it very easily using the Fred database. Just type in 10-year break-even inflation rate into the search bar, and this will pop up. Now, you can see the current rate of break-even inflation over a 10-year period is just under 3%. So should you buy 10-year inflation-linked bonds now? Well, that turns into a question which is, do you think inflation will exceed an average of 3% over the next decade? If you do, then yes, buy inflation-linked bonds. If you don't, then go for normal treasuries. Now you can get equivalent data from the Bank of England, but you really have to dig on their website to find it. If you are one of our Patreon members, we have a spreadsheet which has already excavated the data from the Bank of England. To see how important that break-even rate is, this is looking in the top panel at the outperformance of the TIPS fund versus the normal government bond fund. So when this line is rising, that means TIPS are outperforming normal government bonds. And when it's falling, it's during periods when inflation's relatively low and the TIPS fund is underperforming the nominal bond fund. Now notice how the rises and falls are very strongly linked to that 10-year break-even inflation rate. When the break-even inflation rate was falling, so was the performance of the TIPS fund relative to the normal government bond fund. And in this bottom panel, you can see the rate of CPI inflation in the United States, which in turn is very similar to the movement of the break-even inflation rate. And it's no surprise that recently, when we've had this huge spike in inflation, the 10-year break-even rate has also shot up, and so has the outperformance of the TIPS fund versus the nominal government bond fund. So the key thing here is to be aware of the break-even rate and to form your own opinion of whether inflation will exceed that rate over the next 10 years, say. Now, there's nothing that's going to tell you whether that's true or not. It's just going to have to be your judgment call about inflation. So I hope you enjoyed meeting Norm and Tony, and hopefully they gave you an insight into how inflation-linked bond funds work. Also, why break-evens are so critically important. If you don't understand those, then I'm not sure you should be trading these things in the first place. I wonder what we'd call a UK inflation-linked bond fund. Maybe Ian. Anyway, put your ideas in the comments, and remember our offer from NordVPN. If you want to learn more about that, just look at the link in the description. And as always, thank you for listening.